Given the recent uncertainty surrounding the markets, everything from sovereign debt problems to Chinese inflation issues, investors are somewhat leery on what to do with their portfolios. To share how investors could implement an equity investment strategy that focuses on safety and Canadian value investing, I've invited Allan Meyer. He's Vice President and Portfolio Manager with Wickham Investment Counsel. Welcome to the show, Allan.
Thank you very much for having me.
That's an interesting sort of concept. We want a certain element of safety and Canadian value. How do you do both?
Well, it's a combination of the two. So one of the first things is we tend to be with very conservative people. They don't want to lose the money. So we focus on safety. And there's a number of factors that go into that. A couple of the things are to have a low PE company. Company that has a 7 multiple on a price to earnings basis. If they disappoint with their earnings, their stock is likely to fall much less on a percentage basis than a company that has a lot of expectations in it, like a 70 PE. That stock could fall much larger on a percentage basis. So a low PE is one of the things that we have from a safety standpoint. Also debt. Debt can get you into a lot of trouble.
Well, big debt, a lot of debt.
Yeah. So we put a limit in that. And we say we don't want to look at companies that have excessive debt. So debt over 1.5 times equity. So again, it's a safety measure. It just makes us more comfortable. No debt is good. Also, then we look at interest coverage. It's kind of a fixed income sort of a idea. And the higher the interest coverage is, the more comfortable you are that if they do have some debt, they're going to be able to cover that as well. We even put in a factor in that we call Graham and Dodd. We look at the current assets minus the current liabilities, working capital, and look at that by comparison to share price. And a company with a lot of working capital can look very good, especially.
Well, they can withstand a lot of shocks to a system when you've got the capital to back it up.
Especially like with if you don't have any debt. So it is wonderful.
Now, when you look at corporate balance sheets right now, we're hearing that they're pretty flush with cash. And a lot of the metrics that you've outlined here seem to be in place. Are there certain sectors that tend to fall into this sort of favor and make your short list right now?
There are. We find that there are sectors that come in and out of it, you know, and sometimes it can really dominate our strategy. So it is something where you can have a lot of companies. And right now, there are a lot of financial companies, for example, that are doing surprisingly well on an earnings basis. So.
And so they can be included. All right, so let's assume they hit all the metrics, they get into the portfolio. What are some of the metrics that say you're out based on that safety element?
Okay, well now we would look at companies. First of all, you got to have a market capitalization over 200 million. So we don't want to focus on anything that's too small. So there is a little bit of safety in size, but 200 million gives us a level of comfort. Now, when companies they get out of the portfolio if their debt is too high, if they disappoint on when they report their earnings, and we look at a rolling 12-month period of time, and if they're down significantly below a certain point, then we will kick them out. It's a sell signal. Also, if
no second chances there. Well, like how long do you can have a bad quarter?
Yes, but we're rolling that over a 12-month period of time, so that we're going to factor that in. So, and it's got to be fairly significant, like over 7%, you know, and since it's not just a short period of time over the 12-month. But also if analysts are cutting their estimates, and that can be something that happens very quickly. And again, it's a larger percentage that we would have there. But if they're cutting the numbers, we would get rid of them as well.
So what sort of volatility do you have then in the portfolio?
We actually we did a back test, and when we looked at it, we had a lower beta than the market did, you know, so a lower volatility than what was in the market. So it was actually very good. So
the next point then that a lot of people are talking about is dividend income. And how important is that? That isn't something we've talked about, but I have to assume it's got to be one of your metrics if you're talking safety.
It is. Now, one of the value items that we talk about is dividends, and so we put a rating on the dividends. That's one of the factors that we like to look at, and so it is a very important component too. And if I can backtrack for just a moment, one of the big factors that we look at is the free cash flow. This is one of the valuation factors that we look at. So the dividends are a factor that we really want to look at. Price to book is another, but the free cash flow. And we look at free cash flow. So it's a cash flow from the company reports, and then we take off the capital expenditures that the company needs to stay in business. So if you're manufacturing widgets, you need to put so much money back into maintenance and buying machines. So we deduct that off of it. And then we look at that cash flow, the free cash flow, and we compare it to the enterprise value. And we look at the number of shares times the share price, and we add the debt. And if they've don't have any debt but they got cash, we take that into consideration as well. And it gives us a number or percentage over the enterprise value. And the beauty of this is that you can use that number and say, I've got inflation of a certain percent, and we've got a risk-free asset because we can put money into bonds or something else. And we say also there's an equity premium that we need. So when we factor these things in, and they change over time, depending on whether you're in inflationary time or not, and we can look at the free cash flow to enterprise value and actually say, now that looks attractive. Right now, the free cash flow and enterprise value of 8.5%, 9% looks very attractive.
Yeah, absolutely. Yeah. So when you're comprising this portfolio, do you do it by market weight or equal weighting?
We do an equal weight. We tend to deal with individuals. We're not dealing with large pension funds or mutual funds that have billions of dollars that have to be concerned. So once we have the $200 million market capitalization, we then look at an equal weight. One of the reasons I don't like market capitalization is I still remember Northern Telecom and what a large percentage of the market was.
I'm sure many people do.
I hope they don't forget that lesson.
Well, and a lot of people are talking about other companies, Apple comes to mind, like just how large they are getting and the weighting. So when an average investor is building a portfolio like this and you've got all of these metrics, how many stocks should they really have in their portfolio?
I have seen studies that show that you can have good diversification with as little as 12 stocks.
Yeah, I've seen those studies too. 12 to 15 I've read.
Yes, and we did this strategy with 30 names, so 3.3% on average sort of exposure. If it blows up and gets cut in half, it hurts, but it's not going to really wreck the portfolio. But you get 12 names or 15, that can hurt, if one name goes sour. So equal weight. Now, we did do another follow-up strategy where we had it with 20 names, so 5% positions, but we put a limit as to how much you could have in any one sector. So you couldn't have financials being dominating with 50% or something.
20% was it?
Actually, it was 20. It was 20%. Very good. Yeah.
Interesting.
Yeah.
Okay, so a couple of names that would stand out, given all the metrics that you've talked about. Let's share some of those.
Let me just check my notes a little bit. I did because I I'd get nervous. But there were a few names that did stick out, and. One of the things about this strategy is that it focuses us on names that maybe we wouldn't have considered otherwise. And one of the first names is a paper and forest company, a pulp company, Canfor. Pulp used to be an old income trust. And it looks just great. It has got a low multiple of PE that's under 9 times, and it's got a great free cash flow to enterprise value. And the yield, but no debt. No debt. So you're not going to get into too much trouble.
Your face just lights up when you talk about that. No debt.
Well,
it's a sweet spot.
It is. If they got lots of cash. But, this one looks just wonderful. It's got a yield of 9%, kind of like, it'd be wonderful. With companies that have yields like that, you don't need any appreciation, just sort of stable.
Slow and steady.
Yeah, that'd be wonderful. So Canfor is one of the names. And then there's Canaccord, a financial. And again, this is a name that I would not have wanted to look at. The business is too volatile, it's up and down. But they've got, again, very little debt. They've got net cash. The Graham and Dodd is huge on this thing. They've almost got the share price in cash. And this is a company that recently increased their dividend by 33%, so it's now got a yield of over 3%. There's wonderful opportunity with this company. And right now it's at a very low level. The markets are nervous, and they're punishing these stocks. And we're looking at it and saying, well, this is really good safety and value. So we're very comfortable.
And give me one more.
There was Magna. Magna was,
now that one doesn't surprise me.
Yeah, it does. It's well, now that Frank is out of there, great man. I really appreciate what he did building this company, but the company is better for not having him there, I believe. And very low debt, good cash flow, very reasonable, and the expectations are not high on that stock. So I think there's another one. It looks wonderful.
So when you're going through this period of volatility, and there is a tremendous uncertainty, and there are a lot of headwinds, how are you finding clients through this? When you explain your parameters of the portfolio, what makes a short list, what triggers the sell, is it making them feel any better?
We do have nervous investors. We tend to.
We all do.
Yes. We tend to focus on conservative clients right away, so they tend to be maybe a little bit more nervous. But we try to make certain that we have the proper portfolio structure, that is enough bonds, cash. And we tend to go with the blue chips. And once you explain the process where you're focused on these companies with low debt, low PEs, they understand it. Some of the names they might not recognize of Canfor. They would recognize some of the other names, but when they understand the process and the results, they're very pleased with that.
And so people that are watching you right now, when someone's going to start building a portfolio, what is the very first thing that you do? How do you just get started on this?
One of the first things is we give them a questionnaire, outlining their concerns, the risk tolerances, the time frame. A lot of it is, to do with their age and their risk tolerances and what they expect, whether they're going to sleep at night if their portfolio drops 10%. If they're not, then we've got to really reduce the risk a lot in the portfolio.
Now, how concerned are you over the sovereign debt issues, regardless of how the resolutions are happening? Some would say they're just kicking things down the road, and that'll continue to put pressure on the markets.
I think I agree that it is something that is being pushed off down there. They need to deal with it, but nobody seems to want to really tackle it at this point. But I think it is largely reflected in the markets. We've seen here in North America, a lot of the companies, especially the financial institutions, reporting and indicating what their exposure is. And fortunately, our Canadian banks have very limited exposure to some of these problems that they're having, the sovereign debt in these other countries. European banks and financials, they have a lot more exposure to those.
They sure do. But for now, we'll look at some of the metrics that you've provided, and we can shortlist our stocks and go from there. Thank you so much for joining us, Allan.
Thank you very much for having me.
I've been joined by Allan Meyer. He's the Vice President and Portfolio Manager with Wickham Investment Counsel.